Internal control is a fundamental component of corporate governance, enterprise risk management, and organizational accountability. It comprises the policies, procedures, governance mechanisms, and control activities established by management and the board of directors to provide reasonable assurance that organizational objectives will be achieved while safeguarding assets, ensuring reliable reporting, and maintaining compliance with applicable laws and regulations. Within the program, internal control is viewed as an integrated management process embedded throughout organizational operations rather than as an isolated compliance function. A robust internal control framework strengthens organizational resilience by reducing operational risk, supporting effective decision-making, preventing fraud, and promoting sustainable value creation through sound governance and effective risk management. The board therefore has ultimate responsibility for maintaining an effective system of internal control that protects shareholders' interests and organizational assets, while ensuring that the system is reviewed regularly to remain appropriate in a changing business environment. The governance of internal control depends upon the clear allocation of roles and responsibilities throughout the organization. Responsibility begins with the Chief Executive Officer, CEO, who has ultimate executive responsibility for ensuring that an effective internal control system operates throughout the organization. The Board of Directors provides strategic oversight by ensuring the adequacy and effectiveness of internal controls while establishing corporate governance policies that define the organization's overall control environment and risk management philosophy. At board level, internal control therefore supports strategic governance by balancing performance objectives with accountability and risk management. Supporting the board is the Risk Committee, which assists directors in fulfilling their risk management obligations by advising on organizational risk exposure and the effectiveness of control responses. Executive management translates governance policy into operational practice by establishing internal control policies, implementing control procedures, and monitoring their effectiveness across business activities. This management responsibility ensures that strategic governance principles become operational reality through appropriate policies, procedures, segregation of duties, authorization processes, and performance monitoring systems. Effective executive leadership therefore plays a critical role in embedding a strong control culture throughout the organization. Internal control is also the responsibility of heads of business units, who establish detailed control procedures appropriate to their operational areas while ensuring compliance with organizational policies. Internal auditors independently evaluate the effectiveness of internal controls and recommend improvements where deficiencies are identified, providing objective assurance to management and the board. External auditors contribute by advising management regarding the establishment and monitoring of internal controls, although primary responsibility remains with management rather than external assurance providers. Finally, all employees contribute to internal control by operating established procedures correctly and reporting control weaknesses or irregularities as they arise. This organization-wide allocation of responsibilities reflects the principle that effective internal control is everyone's responsibility rather than solely the responsibility of auditors or senior management. The program identifies three principal objectives of internal control systems. The first objective is the reliability of financial reporting, ensuring that accounting records and financial statements accurately represent organizational performance and financial position. Reliable reporting strengthens investor confidence, supports informed decision-making, facilitates regulatory compliance, and reduces the risk of financial misstatement or fraud. High-quality financial information therefore underpins both effective governance and efficient capital market functioning. The second objective is the effectiveness and efficiency of operations. Internal controls support operational excellence by promoting consistent procedures, efficient resource utilization, performance monitoring, and continuous process improvement. Appropriate controls reduce waste, minimize operational errors, improve productivity, and ensure that organizational resources are used economically in achieving strategic objectives. By integrating control activities into daily operations, organizations strengthen operational resilience while enhancing competitiveness and long-term organizational performance. The third objective is compliance with laws and regulations, ensuring that organizational activities conform to legal obligations, regulatory requirements, internal policies, and ethical standards. Compliance controls reduce legal exposure, financial penalties, reputational damage, and governance failures while supporting responsible corporate behavior. In addition to these objectives, effective internal control systems provide significant organizational benefits. According to the framework, internal controls facilitate the prevention and detection of fraud and error, reducing opportunities for asset misappropriation, financial manipulation, or operational misconduct. They also contribute to the safeguarding of organizational assets, protecting physical, financial, intellectual, and information resources against loss or misuse. Furthermore, internal controls promote the accuracy and completeness of accounting records, ensuring that transactions are properly authorized, recorded, and reported while supporting effective financial management and audit assurance. Additional benefits include the orderly and efficient conduct of business operations and the timely preparation of financial information required by management, investors, regulators, and other stakeholders. Well-designed control systems improve decision-making by ensuring that reliable information is available when needed while facilitating accountability throughout the organization. As organizations become increasingly digital and globally integrated, internal control systems also contribute to cybersecurity, operational continuity, fraud prevention, and enterprise risk management by embedding risk awareness into everyday business processes.